Ladies and gentlemen, welcome back to the channel. Here in this video, we will discuss what to expect coming tomorrow morning. We do have a new testimony from Jerome Powell, and he may give us new information that could move markets. We will also go over how this can and likely will affect Tesla stock. Not to mention some very interesting data from the Twitter world and hedge funds and institutions. What are they talking about right now? You definitely don't want to miss that. And finally, we will take a look at the option activity for Tesla as of today and as of lately, and also the technicals for Tesla. Where do the technicals and options kind of suggest Tesla stock is going next? Could we see a larger pullback before Tesla's earnings on July 23rd? Or should we expect Tesla stock to go higher into that event? All of this and much more. Hit the like button and subscribe to the channel if you find value out of this video, and let's get rocking and rolling. So first things first, it does look like Tesla had a little bit of resistance around that 260 level today, hitting a high of $259.44 per share. And yes, the long story short answer is I'm expecting some consolidation, sideways, or slightly down trading action heading into July 23rd. And that would actually be bullish if that happened for Tesla stock. The last thing you really want is Tesla rallying into the 260s, 270s, or 280s and then come crashing down following earnings. And today is in fact Tesla's 8th straight green day in a row, and some of these green days have been massive. So to take a little bit of a breather is definitely on the healthy side. Because let's be honest, July 23rd has kind of already been priced in for Tesla as far as the numbers themselves. Could we be surprised by a boost to free cash flow or profitability that's a little bit more than expected? Of course, but we already have a pretty good understanding of what Tesla's numbers are going to look like. So this rally we have seen as of lately for Tesla has just been pricing in a better than expected earnings to come. Now, whether or not we get new information on next gen vehicles or new guidance, that is something that could definitely surprise markets. But if we don't get any new exciting information, you may actually see a slight sell-off after earnings, consolidation after earnings. That's possible, at least for the following couple of days after earnings, or before earnings for that matter, but some point here in the next 1.5 to 2 weeks, I'm expecting that. Because the real fireworks will be for the August 8th event, and I think there will be some excitement heading into that. And if I were to speculate and just give my best guess, you could see Tesla around that 280 level, maybe 300, heading into August 8th itself. So I don't think we're in for any kind of sustained downward price action anytime soon. But again, a little bit of downward price action to maybe reset that RSI back down under 70 would be good. Today it's at 85.22. Pretty overextended. You can see with a stock like Nvidia, as of lately, Nvidia really from May through June, almost 2 months here, was overbought on the RSI. Stocks can stay overbought for a while. What happened is Nvidia fell, right, about 10%, and is climbing back, but yet the RSI is still only at 59.5. So now Nvidia's almost back up to all-time highs, about $12 off of all-time highs, but the RSI has reset. So Nvidia could hit a new high, and the RSI would not be as overbought as it was around 82 back here around June 20th. But yes, yet again, heading into August 8th, heading, after August 8th, that's where I'm expecting the run to new all-time highs is going to take place. And the long story short version of that, I'm sure you guys know my stance on this, but the only thing that really matters in regards to the Robotaxi event, is it more predictions? Is it more, forecasting than guidance itself, right? Does Elon and Tesla come out with a definitive start date for the Robotaxi network? That's what matters. No matter if it's 1 city or 100 cities, it does not matter. You just want a definitive start date for the robotaxi network. As long as that start date includes 2025, be it the beginning, middle, or end of the year, I don't think it matters, and I think that pushes Tesla stock to new all-time highs and could even cause what could be the mother of all short squeezes on a dollar amount basis. You could see $1 trillion short squeeze up to maybe a $2 trillion market cap, which would place Tesla stock at about $625 per share. In this market environment, with AI enthusiasm as high as it is, market investors looking for other alternatives to play AI, I think that could make a lot of sense and is not too far-fetched at all. But if Tesla comes out on August 8th, and they don't give us a definitive start date for the robotaxi, then I would expect more material downside, and that would just overall not be great. Now, if Tesla comes out and gives us a guidance for 2026 or 2027 for the robotaxi network, I believe as rates come down, the markets will start to pay more attention to that. As we get into 2025, the markets will start to pay more attention to that. But I don't think that will be viewed as positive or super positive for Tesla either. So really, the number one question is, do we get the launch of the robotaxi in 2025 or 2026? I think 2025, and that's why I'm calling for Tesla at all-time highs by October, at the bare minimum by the end of this year. But it also depends what happens with the Fed, the economy, and the labor market, as well as inflation from now over the next 6 to 12 months. Because for better or for worse, that will affect Tesla stock. And coming tomorrow, you have a pretty significant event. Tomorrow's event will be the first day of 2 days of Jerome Powell testifying in front of the Senate and the House. Now, this is not where Powell would typically give us new information, but considering the data has decisively turned pretty negative with your ISM PMIs coming in at the lowest level since 2009. Odds are Powell already knows what that inflation report is going to look like coming on Thursday. It's possible that you could get a more dovish or more hawkish Jerome Powell, and he's going to be grilled by the House and by the Senate. And it's possible he could give us more guidance. I would say, considering the economy has gotten decisively worse since the last time we heard from Powell, there's a decent chance that Powell actually comes out and is a little bit more dovish tomorrow. And that could be seen as a positive. On the other hand, I think there's almost an equal chance that Powell could come out and sound a little bit more cautious on the economy, that maybe the economy is weakening a little faster than they expect, and I don't think that would be seen as good news by the markets. Remember, usually bull markets end because of the Fed in, historical precedents. Besides the Rona and the dot-com bubble, inflation and the Fed go hand in hand with bull markets. You can even look at the period of time from 2005 through 2008, where the Fed took the federal funds rate from 0.25% up to 5.25%, essentially where we are now, and then we're forced to start cutting rates when the whole system was on the verge of collapsing. And usually when the Fed becomes more cautious on the economy, that's when stocks tend to react. Now, why would the Fed sounding more cautious about the economy, sounding more concerned about the economy, potentially be a negative for markets? Well, it comes down to why stocks have been going higher to begin with. This is an image of the next 12 months projected earnings per share for the S&P 500. You've seen what happened in 2022. It was downwards, and you've seen stocks reflect that. Well, what's happened ever since about February of 2023, expectations have just went higher and higher, with a vast majority, about 50% of this overall gain or growth in expectations coming since December, February of 2024 alone. You've added all of this onto that. It could be hard to, just meet expectations, even if the economy is strong. But if the Fed sounds more cautious on the economy, that could cause some analysts and some investors to say, how strong is 2025 earnings actually going to be? If the Fed is concerned the economy could weaken further from here, does that change the outlook for earnings for the S&P 500? And the answer would be yes. And that's really why we haven't seen any material downside. It's been straight up as far as earnings expectations. If earnings expectations did come down a little bit, then that could mean some larger downside. So keep this in mind just going ahead, heading into this earnings season, even this Friday when you have your major Wall Street banks, Citi, Bank of America, and others that report earnings. Anything that has to do with consumers spending money, that has to do with, the economy slowing down, or question the growth or durability of earnings expectations, that's where stocks can start to take a pretty dramatic hit. And what you've seen over the last 8 months or so with these expectations just skyrocketing is pretty dang abnormal. Bob Elliott says on X, U.S. stocks experiencing a surge in earnings expectations, not actual earnings. Investors are set up for disappointment ahead. He says 12-month forward EPS estimates have surged $260 when you blend 2024 and 2025, while actual earnings have been flat around $225 for 2 years, plus paying 21 times forward, levels only seen in the tech bubble at these bond yields. So in all actuality, you've only been at about $225 of EPS for about 2 years. You're expecting that will balloon to about $260 of EPS by next year. I mean, that just sounds crazy in and of itself. This thread goes on to say many market commentators who are bullish on stocks will note just how strong the 12-month forward earnings are and how those have been growing in recent months, now up 12% on a year-over-year basis, in notable contrast to more timely economic data, which has been flat or worsening. But it's important to remember that those forward expectations are not actual earnings that have been achieved. They are expectations of those earnings. In the past, these 12-month forward expectations have generally aligned with economic momentum with more beta. Not today. As you can see here, nominal GDP is actually falling. It's been falling for a while now, and EPS estimates have been rising. The two tend to follow each other. It looks like in the past 40 years plus, you've only seen this divergence happen one other time, and that was from, 1996 to about 2000 or so, where GDP actually did well. It kind of traded sideways with an upwards trend here. But the forward earnings on the S&P 500 was actually falling during this time. Now, that was a great time to be in markets until it wasn't anymore. But then again, the economy was doing fine during this period of time. It was earnings estimates that were going lower. This time it's the opposite. Economy is weakening and earnings estimates are going higher. I would argue that's a recipe for disaster. Eventually. The question really is, does that day of reckoning come for earnings expectations this quarter, next quarter, or next year? He also goes on to say, at an index level, top-line sales growth rarely diverges from GDP growth. Today, that's in the ballpark of 5%, just a touch below top-line estimates of 6% for 2024 and 2025. It's the margin expansion expected that is notably extreme, penciling out the highest levels ever in 2025. So again, you really have this strong divergence of economies getting worse, expectations are going higher. And perhaps that's because we've had better than expected earnings for a couple quarters in a row. And you see what happens with Nvidia, for an example, when that happens. Expectations balloon and get substantially better. Now, as I have mentioned in other videos, I do think as long as the economy is on a path to a soft landing, this is a very contentious subject. I personally don't think you can have such a large boom like we had without a bust. Question is, does that bust come sooner rather than later? And I've studied old school economics for a long time. I think that is more accurate and reliable to the modern day economics that people talk about today. Simply put, whenever there is a boom, there's a bust. And the bigger the boom, the bigger the bust. And I don't think that ultimately changes in this cycle. And in fact, we haven't had an organic recession in about 15 years. It's It's going to happen, in my personal opinion. Question is when? This year, next year, 2026? Could be beyond that. So what could happen between now and that bust is interesting. I do think, again, if you've watched this channel over the past couple of days, a rotational correction could be coming. I do think earnings expectations for big tech, for an example, are far too high. But if you look at something like the Russell 2000, it looks damn attractive. Take a look at this. So just last week, the estimate for Q2 GDP growth, or EPS growth for the Russell 2000, this current quarter that we're in, was 13.8%. It jumped up to 19.5%. That was a big jump in just the last week, and that's why the Russell is outperforming today. So you're expecting almost 20% growth for Q2 in EPS. For Q3 of 2024, you're expecting 63.1% growth. In Q4 of this year, you're expecting 89.4% EPS growth. In Q1 of 2025, you're expecting 47.8%. In Q2 of 2025, you're expecting 52.5%. In Q3 of 2025, you're expecting 33.4%. In Q4 of 2025, you're expecting 27.2% EPS growth. And Q1 of 2026, we're projecting 29.1% EPS growth. This is way faster than the S&P's projected growth of 11% this year and almost 15% next year. Now check out this pretty wild call from Citi. They say the Federal Reserve might cut interest rates 8 straight times beginning in September for a total of 200 basis points as the economy heads for a sharper downtrend. Citibank says get ready for a bonanza of rate cuts from the Federal Reserve that starts in a few months and extends all the way into next summer. In a note released on Friday, the bank cited fresh signs of a slowing economy for its view that the Fed will trim rates 25 basis points 8 times starting in September and extending to July 2025. That means from now until July, you're going to see the federal funds rate, according to Citi, cut from 5.25 to 5.5%, where it is today, down to 3.25 to 3.5%, where those rates will remain for the rest of 2025. The economy has cooled off from its heady pace in 2023, with inflation resuming its slowdown after some unexpected stickiness, said Citi analysts led by Chief U.S. economist Andrew Hollenhorst. But the Institute for Supply Management Service Sector Gauge, which abruptly reversed into negative territory, and the monthly jobs report, which showed unemployment rising to 4.1%, have raised the risk of a sharper weakening of economic activity and a faster pace of rate cuts, they added. The data, along with dovish comments from Fed Chair Jerome Powell on Tuesday, suggest the first rate cut will very likely come in September. They say, quote, a continued softening of activity will provoke cuts at each of the subsequent 7 Fed meetings in our base case. So that's a base case. If the economy weakened further or faster, you could get more than 8 cuts. But they're firmly expecting 8 cuts in a row. That's crazy. Nobody else is expecting that. They say, or they note also, that other signs of weakness are in the jobs report. While the headline payroll gain of 206,000 appears solid, prior months were revised down, and June saw a decline of 49,000 temporary service jobs, with Citi calling it, quote, the type of decline that is typically seen around recessions as employers begin reducing labor with the least strongly attached workers. They say payroll data are also likely skewed to the upside, leaving the unemployment rate, which is derived from a separate survey, as the more important metric, is said. And on that front, Citi pointed to the SOM rule recession indicator and said it could be triggered in August if unemployment continues to rise at its current pace. Hollenhurst has been a relative contrarian this year by maintaining a dimmer view on the economy, even as the Wall Street consensus shifted to a soft landing. In May, he doubled down on his warning that the U.S. is headed for a hard landing and that Fed rate cuts wouldn't be enough to prevent it. That followed a similar forecast in February, even amid blowout jobs report. In an interview with Bloomberg TV on Wednesday, Hollenhorst noted that a sharp recession would likely produce enough political consensus for more government spending to stimulate the economy, overcoming concerns about the massive deficit. But a more mild recession may not result in such a consensus, he added. Basically, if the economy weakens too much or too fast, then you get another government bailout. If the economy just continues to slowly weaken into a recession and things aren't too bad, then you likely don't get much action at all. He also pointed out pointed out that just as the Fed rate hikes slowed the economy less than anticipated, rate cuts have not stimulated as much. In addition, 10-year bond yields, which serve as a benchmark for a wide range of borrowing costs, are already below 2-year yields, leaving less room for further downside, especially as rising deficits and inflation add upward pressure. Basically saying that the government spending money like they are, outside pressures to the bond markets could make it so that the bond market might not be as reactive to the Fed actually lowering rates, because maybe the world doesn't want to buy bonds. Actually, not under that assumption. I do think Treasury yields would be responsive to Fed policy. And I do think if the economy does weaken to that point, if we get a scare from Jerome Powell, a growth scare that is, or even a growth scare from earnings, you'll likely see money go into the bond market, which may drop yields even faster and more than we expect, because there's typically that flight to safety when you do see problems arise. You can see that in 2020 and 2021, right? From 2018 really through 2020, you've seen this flight to safety as really, concerns were growing over a recession back in 2018. You've seen this bid in the bond market, and this caused rates to fall during this period of time. And then late 2019, you had this little baby move in Treasury yields that caused almost a 10% correction in home prices, which was crazy. This was actually when I bought my first house, and it was right as yields were starting to spike. I think that first mortgage was like 4.75% I got on that. And then obviously, well, a couple months later, things got way worse, and rates went way lower. But there will usually be a flight to safety if the economy looks troubled. After all, you can get 4% risk-free, and you get capital appreciation if there is a flight to safety. Bonds look pretty attractive right now. So let me know what you think about this information down below in the comment section. Are we set up for a little bit of disappointment around earnings season? Could we see a rotation into areas like small caps, mid caps, or are fears of an economic slowdown too strong to allow that kind of rotation? Let me know your thoughts down below in the comment section. Now, for Tesla stock specifically, it looks like today you have 13 different trades totaling $4.4 million with a positive order value of 100%. This is according to Ortex Interesting Flow Sentiment, so keep that in mind. Wall Street still pretty bullish in the Tesla options market. If you take a look at this Friday's option expiration for Tesla, open interest is only 17.5% calls, 82.5% puts. That means there's almost 5 times as many puts for this expiration than calls. A lot of these puts are old trades. They're not new. And a lot of this was hedging for some of the prior events that have came and passed that have actually turned out to be positive for Tesla, including the shareholder vote, shareholder meeting, and others. Now, if you take a look at today, though, you have volume to the call side of 64.04% and volume to the put side of about 36%. So almost a 2-to-1 ratio, 2 times as many calls compared to puts being traded today in Tesla. That's a pretty positive sign. And from a technical perspective, again, 260 may be a level of resistance until we get, maybe after earnings on July 23rd, maybe heading into August 8th. I do expect we could be, as I said, around $280 or so, as high as $300, heading into that August 8th event, and then with a much larger rally to come after that. But as far as downside here on a technical basis, I would really watch that 250 level first and foremost. As long as we hold support there, that would be great. But I do think if we overall head into some kind of correction, and it's not a rotational correction, then you could definitely see more downside than that for Tesla stock. Perhaps down to that 240 or even 230 level would make a lot of sense, and that would not shake my confidence in the slightest bit at this point. you're above your longer term downtrending line of resistance. That in and of itself is a pretty dang good sign. You're heading to new all-time highs over the coming months. If you take a look at the RSI, that's at 85.5. Tesla's still very strong. And if you take a look at the MACD line is at 17.29, and the signal line is at 14.85. This is some of the best price action, some of the best inflows you have seen since the last big rally we had, which was really from April of 2023 through about July of 2023, which lasted a couple of months. And this rally has happened off of relatively low volume, and it's happened quickly. I think there's room for a lot more volume, a lot more FOMO, some shorts covering to definitely push this thing much higher. The big level you would want to watch, this downtrending line here, is about 230, 227. The longer we stay above this, the lower this trend line gets. For an example, by October, this trend line is going to be sitting at about 210. So, the longer we stay above this, the better. If we got a large correction, we could fall under that. It's possible, but I do think Tesla will still continue to see some inflows, especially we got some big events, big catalysts, big, forward-looking things happening to come soon for Tesla. So very bullish on Tesla, not as bullish on the broader markets, but pretty bullish on the prospects of a broadening out of our markets, a rotational correction, as I have been calling it. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. And if you learned something or like the perspective provided to you here in this video. You guys enjoy the rest of your day, and I will see you in the next one.